Hey guys, welcome back to another one of these sessions. Today I want to discuss with you the hidden costs of high rental yields. So basically discussing the difference between high yielding assets versus market relative assets. So let's dive in and have a look at the difference between these. High yielding asset always seems attractive because you're going to get those chunks of cash out of it. You're going to get high yields which provide immediate tangible income from your assets. However, it's going to boost your cash flow and it's going to be short term. High yields often lead to very significant long-term wealth. However, they don't lead to long-term sustainability. So I'm going to break this down and show you what I mean. Capital growth is a real wealth generator. So capital growth is an increase in your property value over a period of time. This generates substantial long-term growth compared to just your high yield. So your high yields is almost like the lollipop in the store. You want it now. You want that cash flow now, which is always advantageous. And everybody, of course, wants cash flow. But when you're purchasing commercial real estate, you're wanting to be looking at the difference of those cash flow generators also at market growth. And what I'm going to do is I'm going to break this down into a comparative chart and show you the difference of the long-term strategy, capital growth versus yield. So what we've got on the chart firstly is property A, which is 6% capital growth. So that would be in your metro areas with a 4% yield. Now, 4% yield is very, very tight. So it's going to be in one of your more prominent metro areas, probably Sydney type area, or could be Melbourne's probably close to that 5%, and versus a property where you're getting a lower growth, which is 4% growth and a higher yield. So your lower growth immediately is going to be in a more regional area because your growth is not as fast over there, but your yields would be higher because your risk's going to be higher. And I'll explain that to you later on. So for instance, property A, which is high growth, it's 6% growth and a lower yield. Let's say the property on average is going to be 1,790,000. Same property comparison would be 1,657,000. Now, if we look at exactly the same properties, property A, which remember is high growth, which is metro areas, versus lower growth, which is a regional area, but you're getting a higher yield, higher risk. Okay. After 20 years, your property A with a higher growth is going to be valued at in the region of about 3.2 million versus your property B that you bought in a regional area. Same property would be worth on average 2,450,000. Okay, so very big difference there. We're almost at $1 million difference. Now we take that a little bit further. I always say commercial real estate is a long-term strategy. You want to sit and hold. You want to buy good, solid properties that you can hang on to for a while, and these become cash flow properties for you. They become cash kings. Okay, so same properties, same scenario. You've got property A, which is metro property. You've bought this in the city. You've got a 6% growth, and we've just done an average of growth here. You've got a 4% yield. By this stage, your yield would be a lot higher. That property, after 30 years, and I know, guys, you're saying 30 years is a long time, but stay with me, okay? 30 years, that property, which started off at $1 million, is now worth $4,291,000. Whereas property B that you bought in regional, wherever, at 4% growth with a higher yield, so you've been getting the cash flow, much, good cash flow. Everybody wants cash flow. Nobody's complaining about that. Property B, the value of the property is still at $2,098,000. So what is the winner? Long term, your winner is more metro properties where you've got that capital growth, and you're wanting to be buying properties that are in gentrifying areas, greenfield release, those kind of areas where you're getting that market and that growth coming out. Okay, so this little exercise that we're doing over here the high growth properties outperformed the higher yielding properties overall by 43.76%. Okay, so those are your averages. Bearing in mind, this is long term. I get it. I understand it. You're going to stay in the game for a long time. Okay, high yielding properties, often they're far more transient, higher vacancy risk. Like I said, higher risks in total, take longer to re-tenant if you lose a tenant, whereas the higher growth properties have got a lower vacancies. You've got far more people in a metropole area and far more stable, and you can let those properties out a lot quicker. So it's very much a matter of, it's up to you. It's your personal journey. You need to decide where that balance is and what works for you. So you need to be balancing your cash flow and your capital growth. And if you're building up a portfolio, you want to have a little bit of both so that you've got a pull-push kind of situation going on in your portfolio. Then you need to be considering the cash versus the equity, the borrowing and the serviceability, and which strategy is the best strategy for where you are on your journey, your age, and where you're going to. So these are all sorts of things that we look at Revolve Commercial. We help you out with, and we would help you with that strategy depending on where you are in your journey, what you have, age, all of those circumstances, okay? Often we'd say for higher yielding property, it might be better if you're starting to reach that retirement age, but you want something that's still good and solid and stable, that's going to give you the cash flow as well as the market growth, gives you that immediate cash, helps you with the expenses, improves your borrowing capacity as well. Smart investment strategies, we aim for, like I said, both growth areas with strong capital growths. You're looking for good infrastructures where there's school, there's employment opportunity, there's, I said, greenfield release, so those would be in gentrifying areas. You want to really avoid the transient type areas where you're not getting that consistent capital growth, where it might be up and down. It just makes your portfolio a little bit unstable. So you want that good balanced portfolio that's giving you both the cash flow as well as the capital gains. So for long-term wealth over immediate, I would say cash flow, make informed decisions, consider both aspects and balance between cash flow and high yield. Reach out to us at revolvecommercial.com.au. I'm always happy to have these discussions with you. We can dig a little bit deeper. I can explain to you how that works, and give us a ring. Reach out on the link below and let's see if we can help you on your journey go a little further.